Welcome to our weekly show focusing on the key macro trends affecting FX and the broader markets. Today we're going to look at one of the most important factors for those global markets, which is central bank balance sheets and how their direction of travel in 2026 could impact FX. And all this is on the back of last week's FOMC, where Chairman Jerome Powell indicated that having completed quantitative tightening on December the 1st, the US Federal Reserve might now restart a program that could look a lot like quantitative easing and start expanding the balance sheet once again. Along with delivering the expected quarter-point rate cut, many believe that these actions will improve liquidity conditions in 2026, potentially boosting risk assets. And now that all sounds great, but if carried through, the actions of the Federal Reserve could significantly diverge from other major central banks. And that's because for the last couple of years, most of the major central banks have been reducing the size of their balance sheets simultaneously, including the European Central Bank, the Bank of Japan, as well as the Federal Reserve. If now, however, the Fed is loosening whilst others are tightening, then the hope for improvement in liquidity from the US is not necessarily a layup for risk assets, because the Fed's actions could be offset by those other central banks. In fact, liquidity could tighten into next year, which obviously would be a negative. But this divergence might provide some opportunities in the currency markets. The Bank of Japan, for instance, is expected to hike rates in the December meeting. And if they also indicate that balance sheet runoff will continue or even accelerate, then Japan and the US could be following very different paths, and this could benefit the yen. But that would actually be a slightly contrarian view after the steady march higher in the dollar versus the yen over recent years. But with the broad-based dollar index coming under a bit of pressure in recent sessions, the yen may now be primed for a period of relative strength. And the point is that liquidity is not just an absolute story, but also a relative one. And the relative conditions in early 2026 could be significantly different from the ones of just a few weeks ago. And this could be beneficial to the yen. And with that, now let's look at some of the questions we've been getting from our viewers.
Okay, so first up, should I be looking at silver rather than gold?
Obviously, gold has been one of the stories of the last 2 years, making multiple new highs. But in recent weeks, we've seen silver break out and absolutely accelerate higher. So we need to therefore look at their relative performance. When we look at the ratio of gold versus silver, gold has been underperforming, but the ratio is still only at the midpoint of the long-term range, and that suggests that silver can continue to outperform. But remember, silver is much more volatile than gold, so you have to be prepared for bigger P&L swings when taking positions in silver.